You've got a good story to tell, but before we get into that good story, just short of estimates here, what's held back profits in the last quarter?
Well, listen, I think the firm is really firing on all cylinders. It was a great number, record FRE performance, record deployment, record origination, and the flywheel that we've described over the last 3 or 4 years is coming into place. Economic cycle is slowing down a little bit, but from a firm perspective, we couldn't be happier with where the firm is positioned. We couldn't be happier with the trajectory of the outcome and in the quarter, and see a very, very bright year in terms of our backlogs and our pipelines.
You seem super confident. As you say, record quarter of deployment, $50 billion of debt origination. I want to talk about one deal in particular. It's the $11 billion investment for Intel, helping them to fund this CapEx opportunity. And I want to put together that deal with some of the quotes that we've heard from the tech titans in the last week. Alphabet saying the biggest risk here is underinvesting, not overinvesting. Mark Zuckerberg of Meta saying at this point, I'd rather risk building capacity before it's needed rather than being too late. Can we take a step back here and just frame how big this opportunity is in front of us and how long the runway is too?
So I think it's a great question, and I think it's so much more of a secular opportunity than the conversation about the Fed this quarter or this week. Certainly from our perspective, we see a secular global industrial renaissance going on. And people talk about AI, but it's also in power, it's also in sustainable energy, it's in the auto sector as well. And when you look at the breadth of capital that's needed from these high quality companies, it really reckons back to what happened in the US in the 1920s and 30s in the build out of railroads and industrial America. So we see the Intel transaction as really a highlight of the future opportunity and the secular change. And what's really gone on in the last decade or two with the advent of private credit is the breadth of available capital from traditional financing sources, which with indexes and ETFs is all focused on short-term liquidity. There's a real lack of capital to invest and be a partner with these companies over 10 to 15 years. So I think we at Apollo certainly are big believers in that. Our phone has been fortunately ringing off the hook since the Intel transaction. And again, it's really the example of the complete transformation of our firm as a capital solution provider.
Apollo has $700 billion of assets under management, pretty much. It raises a question of whether you're dealing more with the Intels of the world than, say, the Family Dollars of the world. Mm-hmm. And when you're talking about some of these big transactions, is your phone ringing off the hook with calls from Meta, Alphabet, Microsoft, all of the big tech giants that are the new clients of Apollo, not necessarily the sort of smaller firms of tradition?
Yeah, the story, if you look at our firm today, $700 billion, 500 of which is in the credit business, and a vast majority of that is investment grade risk. And so what we've really done in the last 5 to 15 years is brought our cost of capital down dramatically, so we're much more relevant to those companies. So all the ones you've mentioned, plus a litany of many others, we are the prime candidate to be in dialogue with those folks as they embark on massive CapEx changes. And they want to do it. What's interesting about these companies, as you identified, they're mostly investment grade companies, and they don't want to really hinder or harm their holding company ratings or issue dilutive equity. So the ability for us to be very, very thoughtful, bring a lower cost of capital to the equation, and match that solution need up with investors or pension funds or retirees from around the globe, these are the folks that are funding that global industrial renaissance. And that's really the story of the future that we get excited about, and it just shows the flywheel of our business. Again, as you mentioned, we deployed $50 billion in the quarter, $200 billion on a run rate the last year or two. And from our perspective, this is really, when we can get that kind of return with a higher rate environment, which we are clearly in, that's really the story of the future. That's what gets us excited about Apollo, and that's what gets us excited about the flywheel in action at our firm.
You also just raised $34 billion in your latest direct lending fund, which I believe is the biggest ever for that type of fund. It raises this question, though, of whether private lending has transformed itself from lending to riskier and smaller companies for much higher yields to lending to safer companies for, yes, a higher yield than maybe the benchmark investment grade index, but not necessarily the double digits of your. Is that basically what you're telling investors, that don't expect those type of returns because this is safe capital that just invested differently?
Well, you're bringing up the conversation of private credit in aggregate versus direct corporate lending for buyouts. We're in both those businesses in scale. On the private corporate lending for buyouts, we're a major player in that space. And you're right, there's a cycle going on, but that's a smaller part in terms of the overall total addressable market. And certainly direct corporate origination, that's going to be a long-term tool for sponsors to use next to high-yield bonds and leveraged loans. The bigger opportunity clearly is what we're talking about right here, the investment grade solutions. We really call it fixed income replacement. In the past, if you were an investor, a pension fund or an endowment, you could go into the liquid investment grade markets, and spreads are very, very tight there, but you really are paying for liquidity that you don't need. Many of these investors have long duration capital, and they should be investing for 5 or 10 years, not for an hour or two based on an ETF. And so the whole market structure has evolved where it's student body left focusing on short-term liquidity, and there's big gaps of capital needs that have been unresponded to. So we've really positioned our firm, as a few others have as well, to be responsive to those longer-term capital needs, which are not being satisfied today in the current debt markets or in the financial services sector overall.
We've got through much of the first 10 minutes without talking about the Federal Reserve, so forgive me, I have to bring up the Federal Reserve.
That's Torsten. You need Torsten in the seat.
Torsten's got a great call, and it's still standing, just about. Your call at the turn of the year was that the Fed put us back. I just wonder how relevant all of that is as a backdrop to what we've just discussed.
Well, I think Torsten's call in the beginning of the year of no Fed cuts, I think it really was very prescient about how we thought about deployment. And witness what we've actually done year to date because of that call. No doubt the big move, the big secular move in rates was the move the last 2 or 3 years from zero cost of capital to a real cost of capital.
Yeah.
A quarter point move here or there. We don't spend a tremendous amount of time at Apollo thinking about the impact on that. We think much more about this global industrial renaissance. And Torsten still may be right. I think we'll see what happens. I mean, certainly with the news this morning about the Bank of England and other central banks taking action,
yeah,
the Fed will be the one left out. But we don't spend a lot of time whether it's going to be one rate cut or two for the rest of the year.
I have to say, we probably spend too much time, don't we, Lisa, on that conversation?
Well, there's a better story talking about the flywheel of Apollo and the flywheel of
that's it. We're just going to break up the whole show, and for the rest of the year, we're just going to talk about Apollo.
That's what you're here for.
Well, we're here to talk about it, and it's a great story, and a lot of topics. Our private equity business was incredibly active on offense. 5 transactions in the last couple of months, 3 in the last week, and from our perspective, a lot going on.